Hello, everyone, and welcome to another episode of Financial Market Insights for Traders. I'm your host, Sophia, and I'm delighted you've joined me today. Whether you're completely new to forex trading or you've already spent some time analyzing charts, today's episode is one that can fundamentally change how you look at the currency markets. We're going to dive deep into a topic that many professional traders and institutional investors rely on every single day, yet many retail traders never fully understand. Today's episode is called Forex Macro Strategy Explained: Understanding Currency Markets Through Macro Forces. If you've ever asked yourself questions like, why is the US dollar suddenly strengthening? Or why did the euro fall even though the chart looked bullish yesterday? Then you're in exactly the right place. Today, we're going to move beyond candlestick patterns and technical indicators. Instead, we're going to explore the bigger picture. We'll discuss the economic forces that influence exchange rates, why central banks matter so much, how inflation and interest rates shape currency values, and why successful traders often spend just as much time reading economic reports as they do studying price charts. So let's get started. The foreign exchange market, often simply called forex, is the largest financial market in the world. Every day, trillions of dollars change hands as governments, multinational corporations, banks, investment funds, and retail traders exchange currencies. Unlike stock markets, which usually reflect the performance of individual companies, currencies represent entire economies. That means when you're trading a currency pair, you're effectively comparing the economic strength of one nation against another. This is where macroeconomic analysis comes into play. A forex macro strategy is a trading approach that focuses on the broader economic environment rather than short-term market noise. Instead of asking what price might do over the next 5 minutes, macro traders ask questions such as, is inflation rising? Are central banks preparing to raise interest rates? Is economic growth accelerating or slowing? Are investors becoming more optimistic or more risk-averse? How are geopolitical events affecting global capital flows? These are the kinds of questions that often determine where currencies move over weeks, months, or even years. Professional hedge funds and institutional investors frequently build their entire trading strategies around these macroeconomic themes because they understand something very important. Charts tell you what has happened. Macroeconomic analysis helps explain why it happened and what may happen next. One of the most important concepts within a forex macro strategy is interest rates. Interest rates influence where investors choose to allocate their money. Imagine you're an international investor deciding where to park your capital. If one country offers significantly higher interest rates than another, that country's bonds and financial assets suddenly become much more attractive. Investors move money into those assets, creating additional demand for that country's currency. This is one reason why announcements from central banks receive so much attention. Organizations such as the US Federal Reserve, the European Central Bank, the Bank of England, the Bank of Japan, the Reserve Bank of Australia, and many others have tremendous influence over financial markets. However, here's something many new traders overlook. Markets don't simply react to today's interest rate decision. Markets constantly attempt to anticipate what central banks are likely to do next. If investors believe the Federal Reserve will continue raising interest rates over the coming months, the US dollar may begin strengthening well before the next official meeting. Likewise, if traders believe rate cuts are approaching, a currency can weaken even if rates remain unchanged today. This is why experienced macro traders spend so much time listening to central bank speeches, reading policy statements, and studying economic projections. Closely linked to interest rates is inflation. Inflation measures how quickly prices are rising throughout an economy. Most central banks aim to keep inflation within a target range because both excessive inflation and very low inflation create economic challenges. When inflation rises too quickly, policymakers often increase interest rates to slow spending and reduce price pressures. When inflation falls too low, central banks may lower interest rates to stimulate borrowing and economic activity. As traders, some of the key inflation reports we monitor include the Consumer Price Index, often called CPI, the Producer Price Index, or PPI, core inflation measures, and wage growth statistics. Sometimes these reports produce significant volatility because markets are constantly comparing actual results against expectations. Remember, markets don't simply care whether inflation is high or low. They care whether inflation comes in above or below what investors were expecting. Another major component of macro analysis is economic growth. Gross domestic product, or GDP, measures the total economic output of a country. Generally speaking, economies experiencing stronger and more sustainable growth tend to attract greater investment from around the world. As foreign capital flows into that country, demand for its currency often increases. But macro traders don't analyze countries in isolation. Instead, they're constantly making comparisons. Suppose the United States reports GDP growth of 3% while another major economy is growing at only 0.5%. Even if both countries are technically expanding, investors may decide the United States offers stronger investment opportunities, increasing demand for the US dollar relative to the other currency. Employment data also plays a major role in forex markets. Strong labor markets generally support consumer spending, business confidence, and overall economic expansion. One of the most closely watched economic releases every month is the U.S. Non-Farm Payrolls Report. Alongside payroll growth, traders monitor unemployment rates, average hourly earnings, labor force participation, and weekly jobless claims. Why? Because employment influences inflation. Higher wages often lead to stronger consumer demand, which can place upward pressure on prices. That, in turn, influences future central bank decisions. As you can see, macroeconomic variables rarely operate independently. They're all interconnected. Let's now talk about market sentiment. Even if economic fundamentals remain relatively stable, investor confidence itself can drive substantial currency movements. During periods of global uncertainty, investors often seek safer assets. Currencies such as the US dollar, Japanese yen, and Swiss franc are widely considered safe haven currencies. Meanwhile, currencies like the Australian dollar, New Zealand dollar, and Canadian dollar tend to perform better during periods of optimism because they're more closely linked to global growth and commodity demand. Imagine a sudden geopolitical crisis or unexpected financial shock. Even if the US economy isn't performing perfectly, investors may still buy US dollars simply because they view them as relatively safer than alternative investments. This illustrates why understanding global sentiment is such an important part of understanding currency markets through macro forces. Commodity prices also influence many currencies. Countries that export significant natural resources often experience stronger currencies when commodity prices rise. Canada provides a good example because oil exports represent an important part of its economy. Australia's economy benefits from exports of iron ore and other raw materials. New Zealand's agricultural exports, particularly dairy products, also influence its currency. Macro traders therefore monitor commodity markets alongside currency markets because the two are often closely connected. Politics cannot be ignored either. Elections, trade negotiations, government spending policies, military conflicts, sanctions, and major legislative changes can all reshape investor expectations. We've seen numerous examples throughout history where political uncertainty weakened currencies, despite relatively stable economic data. Markets value predictability. When uncertainty increases, foreign investment often slows until greater clarity emerges. Now here's an important point. Does macro analysis mean technical analysis becomes irrelevant? Absolutely not. Many professional traders combine both approaches. Macro analysis helps identify the direction they believe a currency should move over the longer term. Technical analysis helps determine when to enter the trade, where to place stop losses, and when to take profits. Think of macro analysis as determining the destination. Technical analysis helps choose the safest and most efficient route to get there. A disciplined macro trading process might begin by comparing economic growth across countries, evaluating inflation trends, analyzing central bank policy expectations, identifying which currencies appear fundamentally strong or weak, and then waiting patiently for technical confirmation before entering positions. This combination often produces more informed trading decisions than relying exclusively on charts. For those beginning their macro trading journey, education is incredibly important. Understanding global economics isn't something learned overnight. It requires consistent study, following economic calendars, listening to central bank communications, reading financial news, and gradually building a framework for interpreting market developments. Fortunately, there are excellent educational resources available. If you're looking for a world-class, cutting-edge, user-friendly trading platform app, visit crystalbellmarkets.com/platform. The platform is designed to help traders access markets efficiently while providing the tools needed to analyze opportunities with confidence. It's an excellent place to begin or continue your trading journey. And if you'd like to continue learning about trading, investing, macroeconomics, and financial markets in an easy to understand format, I highly recommend checking out the Crystal Ball Markets podcast at rss.com/podcast/Crystal Ball Markets. Their beginner friendly episodes break down complex financial concepts into practical insights that traders and investors at every level can benefit from. It's a valuable resource for anyone committed to improving their market knowledge. As we wrap up today's episode, I'd like to leave you with one final thought. The Forex market is about far more than lines on a chart. Every currency reflects the health, expectations, and confidence surrounding an entire economy. By learning to interpret interest rates, inflation, employment data, GDP growth, central bank policy, commodity markets, geopolitical developments, and investor sentiment, you'll begin to see the bigger picture that drives long-term currency movements. Developing a Forex macro strategy won't make you profitable overnight, but it will provide something far more valuable: context. And in financial markets, context often separates disciplined decision making from emotional trading. Thank you so much for joining me for today's episode of Financial Market Insights for Traders. I'm Sophia, and I truly appreciate you spending part of your day with me. If you found today's discussion helpful, be sure to subscribe, share the podcast with fellow traders and investors, and join me again for our next episode as we continue exploring the ideas, strategies, and market insights that can help you become a more informed and confident participant in the global financial markets. Until next time, take care, stay curious, keep learning, and trade wisely.